Hey everyone, and welcome back to a portfolio update with a specific topic for this video. Now first up, a major overview here. So last week we did outperform the S&P 500, but just a tiny bit. We're up 1.72%, whereas the S&P 500 was up 1.38%. But there's no reason for celebration because since the start of this channel, back at the end of February of this year, we're down 3.61%. Whereas the S&P 500 is up 7.83%. But as I explained last week, you can watch that video, based on the holdings, you can already understand why the portfolio is down. I still have quite a lot of conviction in those positions, and I think they'll do quite well in the second half of this year and onwards. Now in this specific video, I do want to touch on the new position. Finally, this has been on the watch list for quite a while, and that's Celsius. Celsius yesterday dropped closer to 10%. Why is that? Well, I'm going to explain in this video. I'm going to explain why it went from the watch list finally now in the portfolio. Of course, the stock was already at those prices previously. It was also much lower and it was also much higher. Now, I only bought 50 shares so far because I'll explain throughout this video why I think we might see more pressure on the stock in the short run, but in the long run, the thesis still looks okay. So we first start off with something we've talked about a couple of weeks ago with regards to the Nielsen data. By the way, this is on Seeking Alpha. If you want to check those things out, link will be down in the description below. All the articles, you also get a little reduction. You're helping yourself out and you're helping myself as well. So thank you very much for all your support. So they said here, Morgan Stanley analysts noted that Celsius sales growth slowed sequentially to a plus 39% pace for 1 week period that ended May 18, and its market share dipped to 10.5% for the latest week from 10.8%. So not that drastic, plus it's only 1 week. Of note, Celsius pricing for the latest tracking period was down 7.2% year over year. Now, when that happened, the stock went down 12 to 13% or so, and so we've got more analyst comments here with regards to that Nielsen data for retail channel that showed that Celsius year-over-year sales slowed sequentially in the 1 week and 2 week tracking periods. Now, another analyst here, in this case from Wedbush Security, said some of the more near-term data didn't look as good as people were hoping, but I think anytime you have a double-digit move, I would classify it as an overreaction. Of course, since then, the stock has dipped even more. Maybe the overreaction was not done, or maybe someone knows or someone has seen something that we, the public, the retail investors, do not have access to right now. But I've checked the internet, nothing new, nothing out of the ordinary. So maybe it's just stock's reaction. There is also quite some pressure from the shorts, not as big as a SoFi, for example, but that might also affect the stock because, as you will see in a second, if you look at the graph, it's now at an interesting point. Now, the analyst continued by saying he warned that the difficult comparisons will continue for Celsius Holding over the next several quarters as the energy drink maker cycles the distribution and velocity growth since the PepsiCo distribution deal began. We've talked about that in the past. It makes sense. Year-over-year comparison will obviously get tougher for this year, but if you're getting tougher year-over-year comparison this year and maybe a little bit of weakness, next year should be looking much better. Of course, next year with the addition of plenty of new international markets that should help reaccelerate growth in case there is continued weakness. Of course, we still have a couple of quarters to check if the thesis has completely changed, if this is just a hype cycle that is now dying down. We still have some time to see how that will play out in the short run. Plus, the coming quarter, there is the summer, plenty of events, plenty of sponsorship events that Celsius is playing in as well. So more eyes will be on that drink. More people will get exposed to Celsius as well. And so, like I said, right now the stock is at a crucial point because on the weekly, we still have a couple of days left for this week, but on the weekly, we're now under the 200-day moving average, which sits at $67.2. Now, previously, this is again on the weekly, we did dip sometimes a little bit under the 200-day moving average, but then that quickly recovered. Can the same thing happen here? Remains to be seen. We did go a little bit higher. So we have here a double top, which is bearish, which is why you're seeing this selling pressure right now. So definitely not some momentum with regards to the stock. And with regards to the business, we'll have to wait until the next earnings report. That's right now I only have 50 shares in that stock. Can it revisit the $50 mark where previously we have seen some support? Remains to be seen. Now, more specifically with regards to the business, it's always great to look at the big picture in case you think you have missed something. Because if you look at the big picture, this is the 10-year big picture. So clearly, of course, they have been doing something right more recently. But let's take the last 5 years, 4 or 5 years or so. Revenue has increased by over 800%. Gross profit has increased by 923%, and right now, in the last 12 months, net income positive and growing, free cash flow generation and growing as well. Now, of course, if you look at the 5-year performance of this stock, you would be up 5,000%. In the last 5 years, you would be up 5,000%. Now, if I tell you that in the last 5 years you're up 5,000%, you would probably think that this stock is now way more expensive. But no, on the contrary, it's actually cheaper than the 5-year mean. On a forward PE basis, EV to EBITDA, price to sales, and price to free cash flow. Why is that? Well, because you have the perfect mix. Continued growth top line, and now profitability starts to kick in as well. And I don't think we're anywhere near the top for this business. Is it a bit expensive? Yeah, probably. I mean, forward PE 54.1 times is not the cheapest one out there, despite seeing what analysts are expecting with regards to growth, right? For fiscal year 2024, 41% growth year over year, followed by 34.6% growth in fiscal year 2025, and followed by another 30% growth in fiscal year 2026. So this is a fast growing business, top and bottom line, so you're going to pay a premium. Of course, it's always nicer, right? It's always nicer to look for dips. So in this case, we have a small correction here of around $20 or so. So it's definitely better to buy now. If you loved it at $90, you're probably going to love it right now at $64 or $65 as well. Of course, we will have to wait for more information in the coming weeks, maybe in just next quarter, to see if there is continued weakness in the business, maybe with regards to inventory when it comes to PepsiCo. Why am I saying this? Well, because last quarter revenue increased 37% year over year, driven primarily by the North American business and the company's success in sustaining consumer demand growth, delivering unique innovation and overall channel growth, offset in part by inventory movements within our largest distributor, where first quarter 2024 inventory days on hand declined versus the fourth quarter, resulting in approximate $20 million impact, while first quarter 2023 revenue benefited from an inventory buildup of approximately $25 million. Continued by saying that ongoing inventory fluctuations may be expected in subsequent quarters because of our largest distributor constituted 62%, of course it's PepsiCo, of our total North American sales during the first quarter of 2024. So they have already prepared us for something like this. And of course, with regards to the trend, we know Q4 is the weakest quarter, Q1 is usually a rebound, but in this case, the rebound did not happen as big as before. But as international becomes bigger and bigger, I do expect the same trend to continue, where Q2 is better than Q1 and Q3 is of course one of their best quarters. Now, of course, this might not be your cup of tea, no pun intended, even though they don't really sell tea, but they sell drinks. Anyways, this might be your investment, right? But as we've seen, Monster has done extremely well. Red Bull is extremely popular because they are marketing kings, right? Great marketing, Red Bull gives you wings, plus all these stunts, this sports stuff. That's how you get to know Red Bull. But with regards to Celsius, it's a bit different. They are marketing it way different. Because Celsius and Monster, let's be honest, it's for people that do sports, play sports, let's say, but mostly men. With Celsius, you now have a much bigger addressable market because it also is appealing to women, whether you like it or not. It's also, in my opinion, less aggressive. So you might drink it even though you're not that active, let's say. Could be. But then again, you're growing your total addressable market that way. Now, for that, I do want to touch on a couple of things that were mentioned in this Seeking Alpha article by Miguel. Link is down in the description. So it's time to update the Thesis rating upgrade. Of course, I believe he posted this right before the market opened yesterday. So the timing of the release of the article was not great, but the Thesis hasn't changed. So he says With regards to the increase in consumption, that does not come from the customers of other brands, 23%, but from their own incremental dollars and from new customers in category, that's 42%. So even though they are stealing some customers from the competition, what they are really doing is expanding the category. As I said, expanding the total addressable market. It is also worth noting that it is the only energy drink company capable of gaining more than 10% market share in North America in the last 10 years. And to show that this is not an exception, with just 2 months of presence in Canada, the company already had a 5.5% market share in the country, in addition to having more than 15% market share in 12 markets within the United States. All this is being achieved without the shelf product rotation already anticipated by retailers. In fact, this is only 1/3 of the way there. Celsius is not yet operating at full speed on this channel. In the rest, they are already the leader. For example, we've talked about this before. For example, on Amazon, the most representative channel for its sales, since it competes on equal terms against Monster Beverage and Red Bull, it is still number 1 in the category. When its rivals don't have more shelf space, Celsius is the winning horse. Another aspect that differentiates Celsius from the competition is its versatility of use. 12% of sales come through food channels. That is, people use Celsius to eat and even have breakfast with. This is one of the crucial points of the writer's thesis. Without a doubt, PepsiCo has had a great influence in achieving this, and if you ask the writer, he thinks Celsius will end up being sold in franchises like Starbucks, since Pepsi is in charge of the distribution of its ready-to-drink products. Now, he also talks a little bit about the potential expansion of its products, going to zero caffeine products, but then he talks about the risk. The risk being that, well, it will directly compete with products that Pepsi is selling. So it's going to be a tricky situation, but a zero caffeine product makes sense, or lowering the caffeine intake that you have from drinking Celsius makes sense, but then you risk having some conflict of interest with regards to Pepsi. Now, before you start writing your comments of, oh, it's super unhealthy, some reports came out. Yeah, of course, this is not new. Drinking a lot of energy drinks in one day is not healthy. Just like chugging down a full bottle of whiskey or vodka is not healthy either. That doesn't mean that you cannot have a glass or a shot of vodka. Same thing with the energy drink. I think one can will not kill you. I'm not a doctor, but I've been drinking energy drinks for a while, not each and every week or each and every month, but I've had my energy drink intake and I'm still here for now. So that's it with Celsius for this video. That's why it's now entering the portfolio, purely because in my opinion, the stock has dropped enough for me to open a tiny position. Chart wise, we are now just a bit lower than the 200-day moving average. Let's see if we can see a rebound. If not, I'll wait until we reach the next levels, which should be around, in my opinion, $50 marks. Let's see what happens. But overall, the portfolio has not moved that much. I think today is another red day. If we look at Tesla, is down another 2.7%. Of course, Thursday, huge day for Tesla. PayPal is down 1.7% as per usual, but I think it has also to do with the Apple announcement yesterday, even though it's just a fancy schmancy UI thing that doesn't really change much. Google flat, SoFi flat-ish, Palantir flat-ish. Adobe is also expected to report earnings this week, which we're going to cover. Snowflake finally up 1%. I believe that's because there was an insider that bought $10 million worth of shares. So that puts the stock up a little bit, but not by much. Lululemon flat, Meta flat, but back over $500. Intel flat, dLocal down another 2.5%. This thing has been hit each and every day for a while now. So that's definitely on the watch list to add a little bit more. Celsius down 3.4% today, well, right now. Rocket Lab down 2% at the time of making this video. So definitely a red day in my opinion overall. Looking at the watch list, still Genius Sport is on there, Mercado Libre, Sport Radar, Alibaba, Build-A-Bear, Duolingo, and of course Celsius, but Celsius I can remove since we have just added that to the portfolio. So overall, that's about it for me in this video. Do share your thoughts down in the comment section below. Check all the links. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.